In this video, we'll unravel the secrets behind a powerful financial strategy known as the sinking fund hack. By the end, you'll discover how a simple shift in managing routine expenses can earn you up to $250 annually without extra effort.
Here's what we'll cover in today's video. Introducing the concept of sinking funds, delving into the strategy, exploring why it works, maximizing returns, understanding critical caveats, and finally testing your knowledge with a quiz.
The sinking fund strategy is straightforward. First, calculate your total annual expenses, such as property taxes or insurance. Then divide this total into 12 monthly payments, automating these into a dedicated high-yield savings account, or HYSA. As the money accumulates, it earns significant interest until the due date arrives. So why does this strategy work? Let's break it down. First, you get free money. By moving your money to a high-yield account, you could earn between $200 and $250 annually in interest. This is passive income from cash that would otherwise just sit idle.
Second, it reduces your mental load.
By setting aside money automatically, you remove the stress of budgeting for those big annual payments, making them feel like smaller, manageable monthly bills. There's a controversial tip to potentially maximize your returns further. If possible, use a rewards credit card to make your annual payment. Then immediately pay off the card balance using your accumulated HYSA funds. This method allows you to earn cash back or points on top of the interest you've already earned, maximizing your gain. Now let's discuss some critical caveats to keep in mind. First, always adjust your monthly contributions to your HYSA every year in anticipation of inflation, as property taxes and insurance premiums can rise. Second, consider rate volatility. Make sure your savings cover the full payment amount, not relying solely on interest earnings. Third, maintain a separate emergency fund for unexpected events. Do not mix this fund with your sinking fund to avoid issues when emergencies arise.
Here's a quick quiz to test your knowledge. What is the primary benefit of using a high-yield savings account in a sinking fund strategy? Is it 1. Earns interest which adds up to free money. 2. Increases monthly expenses. 3. Decreases the need for budgeting. Or 4. Provides immediate financial relief? You may pause the video now to consider your answer. We'll discuss the correct option next.
The correct answer is earns interest which adds up to free money. The beauty of using a high-yield savings account is that while your money is kept aside for future bills, it accumulates interest, effectively giving you free money. Let's recap what we've covered. We've explored how to implement the sinking fund strategy to efficiently handle annual expenses. Using high-yield savings accounts can turn into a passive income stream. Furthermore, if you're up for it, using rewards credit cards can provide extra benefits. Always remember to adjust for inflation and rate changes, and keep your emergency funds separate from those set aside for planned expenses. Thanks for tuning in. If you enjoyed learning this fascinating savings hack and want more financial tips, be sure to give us a thumbs up, share with your friends, and subscribe. We'd also love to hear your thoughts in the comments section.